These corporate landlords across America are now having to cut the rent because they can no longer find tenants to pay these crazy high rental costs. And this is something that is now driving many of these investors to sell, and something that could cause the housing downturn to get even worse here in Florida. And this is Exhibit A, everyone, of what I'm talking about, what you guys need to be paying attention to in the housing market right now. Is this is a rental house owned by a big Wall Street investor. They're called Amherst Holdings. They bought this house back in 2020 for $250 grand. And they just did a massive rent cut, cutting the rent from $2,600 to $2,000 a month, a 20% drop. And this house, it's still sitting vacant. It's sitting empty. They can't find a renter here in St. Petersburg. And this is a big problem for these investors because they still have to pay the property tax bills on that house. They still have to pay the insurance bills. They're actually losing money right now the longer that house sits vacant. And this is something that's now causing many of these investors to sell. Companies like Blackstone and Starwood Capital are starting to turn into net sellers in many parts of the US housing market, which is a particularly scary proposition for the future of home prices in these housing markets. Because it was these investors that caused the bubble to get really bad in 2020, 2021, and 2022. They bought up all the homes, pushed the prices up. Now the big Wall Street guys are starting to sell silently. Everyone, this is the thing. These Wall Street investors don't want you to know that they're starting to sell. They don't want you to know that they're having trouble renting their houses because they want to get out before the crash gets really bad. They want to be one of the first to the door to still sell at a decent price. And when I go around here in Florida, I find more and more examples of this. There's a house down in Bradenton, about 30 minutes south of here, that I just found. It's listed on the market for $350,000, and the seller is Blackstone. They bought it 2 years prior for $365,000. So they're taking a $15,000 loss. And of course, this is somewhat counterintuitive information I'm giving you, everyone, because the main narrative that we still hear repeated over and over is that investors are buying up homes on the housing market, that Wall Street investors are coming in and buying up all the homes. And they might still be doing that actually in certain areas. It's just more and more we're finding these anecdotal examples of them selling. And here in Florida, these investors own a lot of houses. The Tampa Bay Times just did an article where they found that Wall Street owned 117,000 homes in Florida. 117,000 homes in Florida, with a big spike in purchases in 2020, 2021, 2022. Companies like Invitation Homes, Progress Residential, Home Partners of America, who's Blackstone, Amherst Holdings, who owns that rental that I just showed you back there that's sitting vacant. These are the big players. When you hear of the corporate entities buying real estate, these are the names that you should be thinking about. They bought up all these homes during the pandemic because the interest rates were low, the home prices and the rents were going up, and they told themselves that this was going to last forever. They convinced themselves and their investors that they'd just be able to increase their rents on the top line and earn more and more yield. But a harsh reality is setting in, everyone, and that's that Americans and renters can't afford these rents anymore. They simply can't afford it. I talked to a realtor, and she was telling me that they're doing cash for keys, that they'll rent out a property to a renter at a crazy high rent. The renter won't be able to afford it, and then Blackstone will just pay them to leave the property instead of having to evict them, and then they'll have to sell it. And what's particularly dangerous about these investors selling is they don't really care too much about what they paid for it. You know, they make the decision to sell, they're going to sell it for whatever they need to get rid of it. And so they can really drag down the market price in areas where they sell. Down in Punta Gorda, Florida, I showed you guys a listing a month or two ago where Wall Street investors cut the price over 25% from what they bought it for, and basically lowering the value of all the homes around them in the neighborhood, because the investor doesn't care about the neighbors and the neighbors' home prices. They simply care about maximizing capital. They make the decision to leave, they're going to leave. And this is very similar to what happened in the last housing bubble in the mid-2000s, everyone. Data from Redfin shows that the investor purchases peaked in 2005 in that last housing bubble. And then they started plummeting in 06, 07, 08. Even before prices started going down, the investors got out of the market, the big ones. And we're seeing a similar situation today. The investor purchases have plummeted and then bounced around a little bit. Redfin's saying that maybe investor purchases went back up a little bit in the second quarter, but you can still see they're at a very low level overall. And if you guys are an aspiring investor out there, I want to give you guys a little bit of advice. You know, if you're someone looking at maybe wanting to buy one of these properties, once the prices go down enough, I want to tell you kind of how to put together a pro forma and how to analyze these properties from an income potential standpoint, because ultimately it's the income generation ability of real estate that determines its fundamental value. So the way to kind of underwrite these properties is to look at what your potential rent would be on a monthly basis. Maybe it's $2,100 a month for that house, $2,500 a month for that house. Look at your comps, put your rent in there, times it by 12, get your annual gross potential rent. The next thing you need to do is you need to back out your expenses. You start with vacancy. In a market like this here in St. Petersburg, the vacancy loss is probably going to be around 10%. A lot of these properties are sitting on the market for 3 weeks before they get rented. So 10% vacancy loss here in St. Petersburg. A more market standard vacancy loss is 5%, but you got to deduct for the amount of time that the house is going to sit vacant each year before it's rented. Now from there, here's where the not so pleasant things start. You got property taxes and you got insurance. And we know that both of those have gone up a lot here in Florida over the last 2 or 3 years. And in terms of property taxes, I'm back here at the house I showed you in the beginning, the Amherst Holdings house. So their property tax bill here is $5,100 a year. When you look it up on the county assessor website, it's gonna go up even more next year because the assessed value went up. So don't be surprised if their tax bill goes up to $5,500 for this house that they can only get $2,000 a month in rent on. So that's basically 2.5 months of rent just going to pay the tax bill. Now on top of that, you got property insurance. And I don't know how much the property insurance is for this house, but given how much the rates have gone up in Florida, I would not be surprised if the insurance here is $4,000 or $5,000. So you got 10 grand combined in expenses just from property taxes and insurance. Oh yeah, you got your vacancy rate. Remember that. This has been vacant for 3 months, but let's just say a month. You combine all of those expenses, that's half of your rent already gone, and we haven't even factored in maintenance, utilities, and oh yeah, interest costs. Because most investors, particularly the big ones, finance their purchases with debt in the background, so high likelihood that Amherst is losing lots of money on this house right now, and that lots of investors in Florida and Texas especially are losing money after they pay the bank and pay their lenders. So if you're a buyer, you don't want to get in that same situation, right? The one thing I would stress is if you're going to buy an investment property, make sure it cash flows from day one so you don't have to rely on future appreciation and future rent growth to justify the investment. So put together that pro forma of rent, vacancy, property taxes, insurance, maintenance, utilities, and then include interest cost if you're using debt, and then see what your net cash flow is. And actually the best markets to buy investment properties in America right now are not in Florida, they're in the Midwest and Deep South. So the Midwest and Deep South, if we look at this map on Reventure app, is the areas of the country that have the highest cap rates, the highest investor returns, where you can actually cash flow from day one. A market like Alabama is actually really good for this, everyone, because if you buy an investment property in Alabama, your property tax bills are going to be super low. Most houses in Alabama, the tax bill is like $1,000 a year. The insurance isn't that bad. You can really kind of have low expenses on properties in Alabama, and it's a state that has high population growth. I also really actually like West Virginia as an investment market. I know it's not the strongest economy and doesn't have the strongest long-term growth. However, its cap rates are really, really high. You can get 8%, 9% in many markets, and it's probably going to be stable through this downturn. West Virginia is also adding people for the first time in a long time due to inbound migration. Arkansas and Oklahoma are other markets you should consider, particularly in Oklahoma, Oklahoma City and Tulsa. You can get a pretty good return. One warning there is your insurance costs are going to be a bit higher in Tornado Alley, with the obvious caveat that also we're still in a housing bubble nationally, so if you were to buy as an investor today, there's still price downside. However, those are some areas that I think are better: Alabama, West Virginia, Arkansas, Oklahoma, in terms of delivering return. But I think a great question to ask is, what is going to end up shaking out here on the ground in Florida and in Texas? Because these are markets where the investors are really in deep trouble, and I think we could see a huge correction in these areas, everyone. Prices are already dropping. Median list prices are down 5 to 10% in a lot of these zip codes. The typical home value on Zillow is still only showing a moderate decline, but will likely show a bigger decline into the future as the inventory levels continue to grow. I mean, there's just massive potential for a huge crash here in Florida. And I think a lot of you probably want to make up your mind, right? Like, are you going to wait for the downturn in Florida? Are you going to wait for that to play out? Are you going to go buy in another market that's more stable? Those are important questions to ask if you are an investor. There was actually recently an apartment property close to here in Pinellas Park, an apartment building that just sold at a huge 20% discount from what it was purchased for in 2021. So we're also seeing commercial real estate values drop pretty quickly here, all based on the fact that the rents are now dropping, and a lot of these investors who finance with cheap debt are having to now refinance at higher interest rates. And what scares me about Florida is the fact that the rent, even with these declines, is still really expensive. We talked about how on that house, it went from $1,700 to $2,600, now back to $2,000, but it's still $300 more than it was at the start of the pandemic. And when you look at data on Reventure app showing the rent to income ratio here in St. Petersburg and other parts of Florida, it's crazy. Locals are spending 30, 40, even 50% of their gross income on rent. The local jobs here don't have wages high enough to support these rental costs. So even with these initial declines in rent, we still are likely to see more tenants struggle to pay. We're still likely to see evictions. We're still likely to see more downward pressure on these rental rates until they go to a level that the local tenants can afford. Once they do that, then you can probably safely say as an investor that there's stronger fundamentals supporting the market. You could see here, if we look in a market like Miami, the rent to income ratio is up to 45%. This is crazy, everyone. The typical household in Miami-Dade County earns $70,000 a year. They're paying over $30,000 a year in rent. Just doesn't make any sense. And you can see before the pandemic, the rent to income ratio was in the low 30% range. So that's another data point, if you're an investor, that I would pay attention to, is the rent to income ratio. Because if you buy in a market where the rent to income ratios are really high, you're not going to have any room to increase rents into the future. I mean, the rents are going to be mostly tapped out. Whereas if you go back again to the Midwest and Deep South, you can see the rent to income ratios are much more affordable in the low to mid 20% range. There's even some markets that are in the high teens rent to income ratio, which means the tenants locally can afford the rent, which is actually good news for you as a landlord. You want to be in markets where tenants can afford the rent you're charging. You don't want to put yourself in markets where tenants are going to be on a high likelihood of not being able to pay and are going to be evicted. And if you are an aspiring real estate investor or home buyer, I'd encourage you to go to www.reventure.app right now and check out the Investor Metrics tab, where you can see data on rental rates, cap rates, vacancy rates, that rent as a percentage of income data, as well as other metrics related to shadow inventory and migration for your city and zip code. In general, as a real estate investor, I would favor higher cap rate markets that have a lower rent to income ratio. You could filter these data points on the filters tool to find both zip codes and metro areas that meet your investment criteria. Access all that data under a premium plan on Reventure app for $39 a month. This is going to help you as an investor or buyer make a more educated real estate buying decision in 2024 and 2025.